Wow, Zscaler is down 3.41% over the 1 year. It's down 12.65% over the 1 month, down 3.83. Okay. Wow, look at that. 5-year up 316%. Market cap is reasonable. The revenue, they're a little bit on the low side, 2.3 billion. Forward P is 63. It's a buy according to analysts. Let's take a look at their financials and see high level if it's a company that's really desirable. So first green flag is this revenue growth is very desirable. This shows that customers are buying more of their products and more customers are becoming customers. So very good job. It is slowing down a bit because part of it is just, the arithmetic on bigger numbers. It's just harder to maintain the same percentage as you get bigger because you have to keep growing and compare to a bigger number that you did a year previous. Now, so the growth I really like. Now, let's take a look at their gross margins. I'm expecting it's going to be very high because it's a software company, 78%. Really like 78%. So that's 2 green flags. They are a free cash flow company at 717 million, looking at the trailing 12 months. Now, based on a 30% growth rate and a 78% gross margin, I'm happy to take this times about 30. Just high level, is this worth kind of looking at the fundamentals closer, or I should say the valuation? And I get to about, call it 23 billion, maybe 24. So it's within that range. If I can get to 23, 24, assuming the balance sheet's good. Let's see here. So they have EBITDA. They're not producing positive EBITDA yet. They have more cash than they do debt. So their balance sheet's good. So they have the ability to pay off debt. Let's take a look at that free cash flow statement just before I stop looking at this stock. So free cash flow, I like this growth, really consistent. And the growth rate in free cash is really good, but I don't know that it's 45%. Yeah, it is. Okay. That's a very high growth rate on cash. So, this is a stock. I don't currently own a security stock. I like software companies. I really like software companies. And this one is a good one. I'm going to look at it more closely, Mike, because I like the idea of owning a software company that does security. And I'm going to analyze it more closely for the time being. And heck, if you guys won't mind, I don't see any other questions. Let's kind of jump into a valuation of this company and just go all the way. So this is Zscaler. I'll get into my valuation. Now, I look at a couple of companies that are really expensive, like Palo Alto and Crowdstrike, right? Of course, Crowdstrike was in the news for the wrong reasons earlier in the year. All right, so we've got these guys, Crowdstrike, and the reason I'm starting with Crowdstrike is I tend to like to compare companies that are similar, and Zscaler and Crowdstrike are similar. I'll make some room here in my Google sheet where I have my model. So this is a smaller company. They have plenty of cash, and I'm going to go with an 8% discount rate. I went with a higher discount rate with Crowdstrike because they had so many problems. I mean, they brought some big businesses down, and they were going to have some big lawsuits coming up, which they're trying to get through the Delta one. And it looks like they may be, Crowdstrike is probably going to get out of that, but we'll see. All right, so I'm going to look at their fundamentals on one screen and then just type them in, on the screen that you guys can see. So let's go ahead and move that over here, and I can start typing in all the fundamental data. Okay, so first, 8% discount rate. It says a company with more cash than they do debt, so I'm good with 8%. Their growth rate's really good at 30%. 20% growth rate on free cash flow. It was growing much faster, so I'm going to go a little bit better than that. I'm going to go to 25%, and then 5% long term. I like to be a little conservative. It's probably they may do better than that, and that's all right. I'd rather be wrong and say, oh, the company's worth even more than I expected. But it's not a good idea to be overly optimistic and then buy into a company that isn't worth as much as I thought. So, all right. So here we are at 717 million. We're going to multiply that times 1.25. So that's our starting point. So the intrinsic value of the cash flows, if I grow them at 25% for the first 4 years, and then I grow 5 years after that, security software is here to stay. We need it. And the cash on the balance sheet, let's take a look at what we got there. So we've got 2,710,000,000 in cash. We have debt of 1,240,000. The market cap for Zscaler is 29,730,000,000. Shares outstanding 153 million. Okay, so each share is worth really around $300 a share, and it's currently priced at around $200 a share. So there's a nice discount if we look at the free cash flows. Now, when we look at the earnings per share, I look at the next year because I want to look at 1 year into the future. It looks like their earnings per share for a fiscal year 2025 is expected to be $2.98. It's also expected to be growing quite nicely each year after that. And I'm going to say that it's going to grow at around 20%. So based on earnings per share, it's not quite getting me to that stock price. And I might be a little conservative. Other analysts are saying it's going to grow better. But as you can see, I put more weight in free cash flow because this is the real measure of a company's value. So the stock is actually discounted at 29%. When we look at what analysts have to say about this stock, they believe that the stock is discounted at 16%. So I'm right there with them. My combined valuation, I've got a nice discount on the stock. Now, I like the software space. It just continues to expand, and you can see that the growth rate on Zscaler is there. They're doing 78% margins. That's excellent. You look at other industries, they are battling to get to 20, 30%. So I really like software companies. And this one looks really good. I think I'm going to take a closer look and think about buying into Zscaler. Today it's pulling back. I wonder why. Is there negative stories out there? Yeah, I'm not seeing any big story that tells me, hey, that stock's kind of bleeding and I should get out of it. But let me look at it from a different perspective. I'm going to look at Zscaler and I'm going to compare it to CrowdStrike and Palo Alto. So these stocks are kind of moving together today. Let's look at the year. So, CrowdStrike was kind of like going away from the others, and then it came back down. Palo Alto's been doing well, but Zscaler, for some reason, early in the year, they were kind of like trading together, and Zscaler, even to this point, has kind of lagged. What it doesn't make sense is Zscaler's growth has been really good. So what gives? Is it just that the least known name, like Zscaler isn't as well known? Well, as we've seen, the small caps are getting it done. If we look at the Russell, and I'll open this in a new tab, the Russell over the past year has been doing well, and especially post, I guess, the summertime, we're seeing a really nice rise in the Russell. So if you pick the right smaller cap stocks, they do really well. And, 29 billion, I guess 5 years ago, that was not a small cap. That was probably considered a large cap. But now that you have multiple above $1 trillion valuations, I happen to think that, Zscaler is probably now a small cap. They're probably in that Russell 2000. So Russell 2000 is doing well. So, hey, Zscaler is not looking bad. It's looking like it's discounted and unappreciated. CrowdStrike still is getting a pretty high valuation. Palo Alto is getting a high valuation, and they continue to do well. But let's look at the growth rate in the three companies. Right, we've got CrowdStrike, and then we've got Palo Alto, and let's see what their revenue growth rates look like and see which one is better from a growth perspective. So these guys are growing about the same rate as Zscaler. They are bigger, I believe. So they're growing about the same rate from a percentage perspective. CrowdStrike's 3.7 billion. These guys are 2.3 billion. So CrowdStrike is bigger, but they're not like 10 times bigger. They're just a little bit bigger. And then our friends at Palo Alto, these guys are growing at a lower percentage rate, but they are bigger at 8.2 billion. So Zscaler is right there. I think I'm seeing a lot of value there. I'm seeing that, hey, these guys are getting it done. They're growing their business. It's an attractive software company. And if you look at their peers are doing well. Their stocks are really appreciating, but their growth rates are not. Like in the Palo Alto example, I can understand that their growth percentage rate is lower because it's a bigger number. So that makes sense. So anyway, so those are my comments there, Mike. I think it's a pretty good stock to take a look at. I'm going to put it on my watch list, and I'll take a closer look at that a little later. All right. So thanks for asking, Mike, on that one. Yeah, I appreciate the comment, Mike, and let's go make some money. Let's go make some money on software companies.